An open-ended fund usually has the ability to take those funds and reinvest them in a parallel fund. So the same group could open up another fund and say, oh, well, now we want to invest in whatever. And if your documents describe that that is a possibility, they don't need your permission to go do that. So again, it's all about what is in your documents and what is structured. But I saw that. And so I knew that investors would have had concern with someone like me that's done 7 deals. And then I said, okay, well, I want to do a fund now on deal 8 and 9. How do we calm those fears, right? And so we did a closed-end fund where the investors that come in, that's it. They get their cash and their appreciation value from the sales and refinances directly to them. They don't leave the fund. They don't go somewhere else into another fund. It does say that my company is allowed to open another fund at the same time that's targeting the same assets, but not that we can take those funds that are already committed to one fund and move them to another one. So hopefully that makes sense.
This is the Real Estate Wife Show, and I'm your host, Vinki Loomba. And today I have the Queen of Apartments, Kaylee Mcmahon, back with us. Kaylee has over $70 million asset under management in multifamily. She's the founder of multiple companies. She's also a fund manager for Warner Fund 20. Today we'll discuss how to create a fund with Kaylee. Welcome, Kaylee. Super excited to have you back.
Howdy. Thank you for having me at your service.
Awesome. Last week, we spoke about your success trajectory and your passion to help women in real estate investing. You have created a business intelligence for women to thrive in real estate industry. I understand from our previous conversation that you face multiple challenges to make your space in this industry, and that led you to position yourself in a way that you can add value to other women's lives around you. Let's talk about the learnings and challenges that you have faced during creating your fund and creating this position for yourself.
So a fund means a lot of things, but in this particular situation, it was for the purchase or acquisition of multifamily real estate. And then also if the property had existing storage, that was also part of the plan. And essentially just like a syndication, it's a pooling of funds. It's just a different way to do it. And a fund could be asset specific. You could target one asset, or you could put it together and have a blind pool, semi-blind pool to be able to go after multiple assets at the same time. We created a semi-blind pool fund because essentially when we created it, we were able to do 2 acquisitions right away, which was not really part of the plan, but life is what it is. So then I could disclose to the investors who wanted to invest what was already in the fund, right? So it was semi-blind. So we have about 2 more acquisitions to make before it fully closes down. And then it just sits and collects cash flow, spits it out until the assets all sell off. And then we close it down and dismantle the company. Each fund that you do, so we technically have 1 live right now, and there has to be a base or bottom, or there has to be an entity at the basis of each of these structures. So for us, our first one was a Regulation D offering. D is in Delta. Mm-hmm. And Reg D was a 506C so that we could actually advertise what we were doing. I wanted to show the world that we were mission driven and we were doing something different. Mm-hmm. And because of that, I knew that it wasn't going to be for everybody. And I couldn't just go tell all my friends and those I'd done business with before, hey, we're doing this, because we were specifically wanting to bring in women and couples where they want women to be financially empowered, AKA they need to be aware of what's going on, and she can see financials, she can understand what's going on. So it's not just for women, but those that also support the financial empowerment of women. And a fund, I find, typically serves a purpose or has a investment thesis, if you will. So that's typically, I think, why investors start these. So when you're doing a syndication, typically it's asset-based. And a syndication is, again, a pooling of money using a different type of vehicle, right, or legal structure. So some of them are for minorities. Some of them are for purchasing assets for a certain reason, I guess. So ours was for 2 reasons: financially empowering women by giving men a place to invest, which the company is doing that. And then also we're looking to empower teams of women. So executives in those companies are women. So that is obviously financially empowering them, but also empowering them to show other women in future generations that this is possible. I'm doing it. Partner with us in the future, and also don't discount this as not being for you. We do this too. We also asset manage. We also do construction. We do things that are not, gender specific usually for women. And so that was our, mission. So the Reg D was really easy to get open because if you've ever done these before, I mean, honestly, if you haven't gone to jail, and you go find an attorney and you pay them, they can make one happen. I mean, honestly, in 30 days, you're raising money. So it's really not that hard, to put together a Reg D offering. And so we were able to get that up and running within 30, 60 days, something like that. I'm very thorough with our legal documents. And there are a couple of things in there I wanted to be very clear on as far as making sure that we knew exactly what our fee structure was going to be. Does it compare to the market so that it's reasonable? We set up a dual structure, and each of the funds that you look at can be different. So that's why it's really important that you've done a syndication as a limited partner before, at least a couple of times, and then start investing in the fund, whether it's with the same sponsor or a different one, it doesn't matter. But hopefully the idea is that you've invested, and the first time you looked at your private placement memorandum and you went through a deal and you saw how it worked out, or, maybe didn't work out. And then you know that you need to reference your documents because that's what everything's based on. And then hopefully you're comfortable with that so that when you do get into a fund, you know how to look through your operating documents, operating agreement, your private placement memorandum, your subscription agreement. Those things are typical when you're doing a Reg D, same as a syndication and same as a fund or investment company. But sometimes, and always actually, the funds, because they're so unique, there's not really like a typical template for a fund, if you will. So we have our Reg D offerings where there's certain things that we have to fall within the lines of like Texas Business Code or TBOC. That's just here in Texas. Each state has its own business code. So there's certain things that have to be that way in your operating agreement, depending on the team that's in there. That also has to, obviously, there's like lots of disclosures that need to be in your PPM with who's in it, where you're going to be targeting assets, what you're going to be getting yourself into, and what the track record of the team has been, and what the business plan is going to be for the life of this vehicle. However, in funds, for example, like I mentioned already, you can have a blind pool fund, you have a semi-blind pool fund, you can have a closed-end fund, you can have an open-ended or evergreen fund. And so those are things that I needed to decide in the beginning what we were going to do. Ours, for example, because this is my transition from doing one-off or deal-to-deal syndications into a fund model, we did semi-blind pool because I felt like investors knew me already. And then this was going to give them a way to say, okay, have you actually gotten some assets in here? Yes, you have. Okay, you're going to keep doing that. Let's put our money in. And then also when it came to if we were going to do a capital call structure. So sometimes you can go and have your investors say, I'm going to commit to a certain amount of money. And then you would say, okay, well, what we're going to do is call the capital once you have already put down, and you structure it however you want to. Again, this
exactly. Yeah, I was coming down to that. Yeah.
You could say, I want you to put down 10% of your commitment right now, and then we'll call the capital. So put the remaining in a money market account so that way it's at least making some kind of interest in the meantime. And then when we're ready to go, we can have the funds called. And if an investor doesn't contribute, maybe your rules and your documents are that they can never invest again because you don't want an investor that says, I'm going to do something and then they don't. Or maybe you just don't care and you like the stress. I mean, it just depends. It's your company. So it depends on how you want to structure these things.
Let me stop you right here. I'm going to ask you a question here. So you said you were doing the single syndication, per deal syndication, then you move on to the fund structure. So what is the difference between the two? How do you feel the fund is different than the syndication pool? What is the major difference? Let me ask you that.
So like I was just mentioning, in your structuring or in what you're putting into your documents and how you do things, I have never been in a syndication where they call capital, right? So that's one of a million examples. Another being blind pool versus semi-blind pool being asset specific. Whenever you're doing a syndication, it's usually asset specific. So that's, again, another big difference. We chose semi-blind. And then another slew of things can happen as far as your fees and as far as your structure of who's in the company. So in your fee structure, for example, when you're doing a fund, typically in a syndication, there is a acquisition fee. Typically, there is a disposition fee. Not always, but there's always an acquisition fee. There's always an asset management fee. And sometimes there can be, like I said, a capital transaction fee
Right.
slash dispo fee, those or a construction management fee, depending on what the team is doing. So some of those things don't really apply in a fund because you're not, I am, because we also have a second fund that's actually not a fund, it's a vehicle, but different. It's crowdfunding. I'll cover that in a minute because I can't say it's not a fund. But we have another pool of capital which requires me to be in the general partnership. Now, as far as doing a normal fund, that's usually not required. Like you can be a fund of funds. And what that means is, for example, you find a syndication you want to invest in, and then you have all these investors that are serving this mission, whether it's, hey, we want to invest in minority owned businesses. Okay, bam, I just found a group that's already doing a deal and it's all people of mixed races and colors and lifestyles and all kinds of things. This is a perfect opportunity to invest in. Maybe that's the purpose, or maybe the purpose of it is like, we want to hit, 35 IRR. And so, our group or our fund is going to look for another deal or fund to invest to be fund of funds. And then you're a limited partner at that point, where the group is a big LP, limited partnership that goes into that syndication group. So there's a lot of differences.
Right, different ways. You can structure the fund whatever way you want it. Let's talk about the blind pool fund a little bit here, because since you use that and you have the blind pool fund as well. So in the blind pool fund, how does it exactly work? Because you get the deals time to time, or is it like kind of people are investing, they do not know what exactly they're investing in?
Yeah, so we have a semi-blind pool, but a true just blind pool fund is one where, so for example, again, like I mentioned, you'd want to either follow your sponsor that you've invested with multiple times, so you kind of see what they're capable of, and there's trust created. Or, I mean, I don't know, if you go on crowdstreet.com, those people have to have done 250 million assets under management to be able to even be hosted on that portal. That's just one example. So that you pretty much know that the team is scaled, they have operations, they know what they're doing. This is not their third rodeo. It's definitely like 15 deals down the road or so. And so you can be pretty comfortable that your money's going to do what it says it's going to do in the offering. So if you find an experienced team like that, that would be one where I think a fund makes a lot of sense. We just kind of, anyway, so back to the blind pool, essentially there's going to have to be in the operating documents, but really more so. So in a crowd fund, it's the term sheet, and in the Reg D offering, the Regulation Delta offerings, it's going to be in the PPM private placement memorandum. And there will be a section about the business plan and also disclosures of risks. Both have this, both things I'm talking about. And so you'd want to know what the track record of the team has been. That would be listed in there. And then also more so like, what are the risks of the market? And then what is the criteria that is being targeted, or what is the mandate of this fund? So there could be two sides to this mandate. Like I mentioned, you could have a mission with your fund, or you should, because investors deserve return and also making an impact, I think. But there should also be a section that literally lists out exactly what kind of assets, what area, what zip code, what kind of returns these investments are going to spit out, what the projected exit time frame is going to look like, what the maximum time frame of exit will look like, when am I getting my distributions, what do those distributions look like, annualized, say like cash on cash, right. Your internal rate of return, your annual average rate of return, depending on which metric you care about, something that's going to tell you how is this going to perform. And then, basically the way that you can not guarantee ever, of course, because things outside of our control change, like the market. But I would say that after doing my research and looking at operations systems, the right partners, the right deal, many things, the right market, I would say 80% of all of this is controllable and 20% is those outside factors, but there still is risk. So just basically having in your documents all of the things that could happen. And then based on their track record of doing that same thing, hopefully what the team is doing is they're not going, hey, I have tons of multifamily experience. Now I'm going to go build skyscrapers that have office. Like, hopefully that's not what you're seeing. Hopefully you're seeing congruency. And then, partnering with those and saying, well, they're just going to do the same thing over again. So maybe the first time you invest in a fund, don't dump $1 million in. I would say, put in 100K or something like that, so that it's not going to, you're going to lose everything. But it's really about track record and experience of the team if you are investing in a blind pool fund. And sometimes the good thing about a blind pool fund is that, again, so if we squeeze ourselves too much with the type of asset, right? So if I say I have to hit a 17 IRR and I find a great deal that's like one more year longer hold and it's 15 IRR, it's still a great investment. And so the investors would actually be missing out on something that could potentially have like a 3x return on their money. You know what I mean? So it's a little bit nice when you have a little bit of flexibility in the blind pool. But again, trust has to be there. So again, that hopefully that investor team is not investing. And again, it's in your documents, it will list like what they're limited to. So if they're like, yeah, we can invest in everything, I don't know about that, but if it's congruent with what they've already done, I would think that that's reasonable.
So this blind pool fund, it has a closing date as well, right? There's a time limit.
That's again in the document. So it depends on the team. Typically, if it's a Reg D, the way that, and again, I'm not a lawyer, and so I'm not going to get into the rule number and what this is defined by, but typically there's a way to put into your operating documents what your time limit is to raise the funds. You have to give an idea of when you want this to close down by or not be available. However, there always is, just like in every other deal that we do, when we put together a letter of intent for an offer on a property, there's always several built-in extensions for closing, for example. So it's the same thing in a fund. So typically, say if you have an open window for like a year or 6 months or 3 months or whatever, typically there's enough extensions built in for a full calendar year, because I think that that's reasonable. People, whether it's their job, the market, different times of year, tax reasons, etc., they may not have funds available, but within about a year, usually they do. So that makes sense. And as far as closing it, so there are open-ended funds, like I mentioned earlier, and closed-ended funds. That's not really related to the date per se, but there is a closed date. What I mean by closed-end or open-ended funds is, so a closed-end fund would be one that, okay, say we have a pot, my example, $5 million, $100 million, and you say as soon as we raise that amount of money, there's no more coming in, there's no more leaving. It becomes an illiquid investment. It has now been deployed into real assets. It is now closed. So we're just like a normal syndication, we're just going to sit on it and wait until we get all this cash flow that comes in. Then the cash flow gets, depending on how your structure is, but ours is pro rata or percentage ownership. You're receiving that cash flow at a certain time ticker after you made your investment. So for us, the ticker or the clock starts the day that you make your investment, and then the documents define at what time interval will you get paid after that. So some people could say 6 months. We said a year because typically we're going into these value-add assets that need us to turn over the entire population of the building and do a lot of construction. And so a closed-end fund would be one where, again, we're not taking the distributions for cash flow. We're not taking the distributions from a capital event, such as a refinance, such as a sale. Say we have 5 assets in this pool, and one of them refinances, and one of them sells, and one of them has crazy cash flow. One of them is doing nothing, So essentially, we take the percentage of your ownership of those events, and we distribute that out at our set intervals. An open-ended fund wouldn't be entitled to, and again, it's in the documents depending on what they allow the funds to be used for. But what I have seen is that they'll use those. They'll give you your appreciation, for example, which is your long-term value on your sale. Okay, here's your big check, because that is something that is, like, I don't want to say guaranteed, but I mean, pretty much. But then the cash flow that either could be held for reserves, or it could be distributed out to investors, or a combination of the two. An open-ended fund usually has the ability to take those funds and reinvest them in a parallel fund. So the same group could open up another fund and say, oh, well, now we want to invest in whatever. And if your documents describe that is a possibility, they don't need your permission to go do that. And so essentially, you wouldn't be receiving your cash on cash or your cash distributions like that. And in an interval, you'd be, for sure getting a catch up on a large capital event of one of those assets, like a sale or a refinance. So again, it's all about what is in your documents and what is structured. But I saw that. And so I knew that investors would have had concern with someone like me that's done 7 deals. And then I said, okay, well, I want to do a fund now on deal 8 and 9. How do we calm those fears, right? And so we did a closed-end fund where the investors that come in, that's it. They get their cash and their appreciation value from the sales and refinances directly to them. They don't leave the fund. They don't go somewhere else into another fund. It does say that my company is allowed to open another fund at the same time that's targeting the same assets, but not that we can take those funds that are already committed to one fund and move them to another one. So hopefully that makes sense.
Yeah, it does. I think the way I understand is, as long as you disclose everything, what you're trying to do, and spell it out, everything in the PPM, or the disclosure documents, it is okay to do or structure it any way you want it, as long as all your investors, the general partnership team, the limited partners, all are on board or all on the same page. So I'm going to shift gears here a little bit, as I know we talked in the previous episode as well, and earlier too, you were saying that you're really good at reading documents. So I'm going to ask you a question about the PPM, since we're talking about funds. So I know for a single syndication, you have a PPM, the private placement memorandum that we share with our investors, right? And everything is spelled out. The business plan for, conception to completion, everything is spelled out in there. So when you have a fund, do you have a separate PPM that's kind of resonates the PPM for the syndication? How does that work? If you can shed some light on that.
If it's a Reg D fund, so again, you can do a Reg A fund, you can do a Reg A plus fund, you can do a Reg D fund, you can do a Reg CF fund, you can do a Reg F fund. There's a bunch of different kinds. So each of these are different. I'm only going to be speaking today to the Reg D or Delta fund, and then crowdfunding if we want to go there. So with the Reg D, it's like the same thing as the syndication, where you're always going to get those, 4 or 5 documents. You're going to get your qualification questionnaire. It'll be a little bit different if it's a 506C fund. It could be a 506B. Ours is a C. So if it's a C, that means that our investors have to turn in an additional document that says that they are qualified as accredited from their attorney, CPA. We have a couple verification services that they can use, but that's just specifically for the 506C. So you'll always get your PPM, private placement memorandum, your subscription documents, and then also so your qualification questionnaire / plus, the qualification operating agreement. I think that's the 4th, and I don't know if there's a 5th or if that's it. I think that's it. But the operating agreement is essentially the team's agreement within each other. And so really, like, it's not that the LP or limited partner investor can actually change that. I mean, they could if we put some really egregious stuff in there. And like, I've had a big investor be like, why is that in there? And I'm like, I don't know. I think that's dumb. You're putting in $500,000. Let's discuss it with the team. So we've been able to change that, but not always. Usually it's just the operating team that has to do the acquisitions, dispositions, fundraising, asset management, project management, construction management, and kind of a little bit of property management, that we all talk to each other and say, how are we going to do this? Whose lane is what? And then if things don't go right, where do we go from there? So essentially that's the stuff that's going to be in your PPM. And so for us, for a Reg D, whether it's 506B as in Buddy or 506C, you'll have one of those either way.
Oh, great. So looking at the PPM, when you're reading the PPM, everybody should read the PPM because that's the most important document as an LP investor. So I'm going to talk from that perspective, from the limited partners perspective. So when you get the PPM, sometimes, investor think it's a very lengthy document, I'm not sure where to look for what. If you can highlight some of the areas of the PPM that everybody should read or should be concerned about that, like what they're signing.
I'm actually opening up one right now, so I can kind of try to go by, like, if you could put a document together, you can have like a table of contents, if you will, so I'm kind of going through what's in there. So for us, we attach our subscription agreement to the front of the PPM. So your subscription agreement, you shouldn't fill out before you read the PPM, but that's just how we do it. So a lot of investors, I think, just get this DocuSign, they're like, okay, sure, I'll just click. But exactly. I would say scroll down and read first. And you can even print it out and bring it to your attorney if you'd like to. So essentially, we want to disclose different parts of our PPM that talk about what we're doing with the funds. So what is the purpose of us even starting this company, so that that's very clear to investors that, we're here to make X profit. We're going to be doing it by Y business plan. What is our total amount of raise that we're going to be doing with this document? What are we limited at? Also underneath those, the amount we're raising, say it's like 1.2 million, how many A class and B class, and we can also have other classes also. So typically there's A and B, typically, not always, you can call it whatever you want. So again, you got to read. Typically an A class shareholder is a limited partner. So the investor that brings in the capital and gets to learn and doesn't operate the property, and B shareholders are typically the active general partners. But I have done investment offerings where I've had an A1 share class, A2 share class, ABV1 or whatever. And so it just depends on like your investor base, what each share class gets. And so the PPM will outline exactly what each share class has access to. Can you vote? Can you not vote? Do you get distributions based on cash flow? Do you get just appreciation? Do you get both? Do you get tax benefits? all of the things that you would get with your shareholder position in the agreement. Also, the preferred return, if there is one, is going to be outlined in there. If there's any kind of catch-ups, for example, that's really important to understand. So sometimes we had events happen during, the lockdown, for example, where we couldn't do a whole lot, where people were locked in their units, as far as renovations, so that really stagnated a lot of our business plan. We could do stuff on the outside, but usually we get the money from nice units. So it also gives you provisions, for example, hey, we project we're going to give you this cash on cash. But again, what if we can't? What is the procedure for that? That's always where we disclose these things in here. So if there's a catch up, for example, is it annual? Is it at the end of the investment period? How does that work? That would be put in there. Also, again, a lot of investors ask the question about distributions. What do those intervals look like? When do I get it? If there is a catch up period, how does that work? That'll also be in there, and it'll also define what rules under which we can actually offer these securities, that they are securities. And what that means is it's basically a position in the company, and you're depending on your sponsor or the leader of the investment deal or investment to be able to make decisions that are essentially in a fiduciary manner to be able to take care of your profits, because that is what you're empowering someone to do. Okay, so there's always considerations to be made. That's usually in your proper PPM, private placement memorandum. There's going to be cautionary statements about risks that you're going to run into inherent to the deal type you're doing. So if we're doing value add, that's more risky than an A-class deal that really doesn't need to have a whole lot done to it. People don't need to leave. You don't miss out on that cash flow. So it's just cautions and considerations for the type of investment that you're getting involved in. So for example, investor information for all investors. You may have, again, different share classes. And then also what they need to be looking for is actually like what we're kind of asking. Each PPM should be telling you, here's the sections and subsections of this document. Here's where to go look. Just read the whole thing. Also, judiciary legend. So, for example, what business code? For example, we're here in Texas, TBOC would apply. So, for example, if something doesn't go right, we have TBOC, which would be the first basis of what the state does require for being allowable for voting, being allowable for court jurisdictions, things like that. And again, under what court system would this follow? Because, for example, this is a company. And so this isn't the company agreement, which is the operating agreement, but they're related. So if we have the jurisdiction of like Dallas, Texas, that's going to be listed in there as well. Jurisdictions, a summary of what you're getting into. Also, a lot of investors ask a question about, oh, so can I sell my shares? And that's in this document. So before you sign it, don't ask us this later. It's like, this is in your document.
That's true.
There's a full section that talks about restrictions on transfer. What would be an event that would be allowable under this agreement to be able to transfer shares? What would not be allowable? So this is essentially an illiquid investment. Illiquid, meaning that it's locked into like these walls of brick. And until there is a large capital event, that's when you usually get your cash back. But point is the restrictions will be listed there. Also, use of funds is going to be in the PPM. So what are we allowed to use it for? What are we not allowed to use it for? There's a thing that you'll go through called a cap table or capitalization table. And what this will have is, how this works is that you never know who your investors are until like it closes, basically, because you're raising money as you're under contract, or in this situation in a fund, as the fund is open. You don't know who all your investors are that are going to be in those deals pretty much until either the round is closed. That's how we do it, is by round. So we raise $1 million. We change the operating documents. And we raise another one. It's kind of like pre-seed funding, seed funding, where we raise in rounds because we may not need, because I've got two entities raising at the same time. I may not need to fill this one up. It may all come from over here. So anyway, point is it will talk about the investors, and the capitalization table has investor LLCs in there. It's got all of the information of how much ownership each of them has. It's got their addresses. It's got very private information. So typically this is not something, as you're going through the PPM, you're going to get like a blank PPM that basically is giving you all the information, but it's not going to have all the other investor info, because we also don't want to like send your address to somebody else. We don't need to send them your phone number. You know what I mean? So the investment team, the general partnership, will have that completed. And typically once we get all documents signed and in, we will at the last minute, right upon closing, or however it works with this fund, we'll have our own cap table. We usually have a document that's in a Google document. The Google document is obviously kind of like a public document, and we try to be very secure with what we do. And so essentially it's incomplete until we have it done. And so when it's done, then basically we'll take it and turn it into a real document and then upload that into a secure server and then delete the Google document. And so depending on how you have your Google storage set up, mine deletes everything as far as anything that's in long term. So, I mean, in the trash. So it will just actually permanently delete it. So as best as we can, I suppose. But I never want to like have investor information sitting on a live Google document where people have the ability to get a link and access it, or like that's not okay. So point is but that the cap table has all the investors in it. The executive management team, there's going to be a section in your PPM that covers their track record, who they are, what they've done, their faces, a little bit about like who you're getting into business with. That's also important to know. And don't just believe what's in your PPM. Honestly, I always do a double check online. And then again, I have another service as well that does a little bit more deep search. So for example, if you can find online, I know paralegals can find this pretty easily. You can find if someone has like 7 aliases, that should be a red flag that we need to dig further. Or maybe that's enough for you and you're like, I'm just not doing this. But there are a few like little red flags on people that you can find publicly, and then you kind of need to do more search. But the executive management team will be there. Their roles as well, risk factors of what you're going to run into inherent to the investment and the market. That's also important to know about the market, and not just real estate market, but I mean the physical. Am I going to be investing in Los Angeles, California, or Lubbock, Texas? What's the difference between those risks? So what is, again, the objective and the strategy of our investment? Here's the business plan. Here is the plan of distribution. So for example, sometimes funds have a straight split. Sometimes, most of the time, they have a waterfall structure. If some kind of structure of payment, so everyone wants to understand, okay, if I put in this much money and this event happens, who gets paid first? What gets paid next? So for example, we've done some deals where we have a 1031 exchange and that person comes in as a TIC or tenants in common. So it's not even part of the waterfall. I'm just trying to make this like, what could this turn into? That person and the lender, for example, lender first gets paid, but then we're distributing to our partners. So a syndication is not a TIC. They would partner, but the TIC would get paid first unless we have a different agreement. And then usually inside the partnership agreement, there is a payment to the limited partners of preferred return first off the top. So for example, like what does a preferred return mean? Okay, so we make like $10, and the preferred return is 7%. So out of the $10, we're going to distribute 7% of that money to the limited partners first. Mm-hmm. And then basically what is remaining, then there's typically a split between the partnership and the general partnership. So, or limited partnership and general partnership. After that 7% is paid off the top of that $10, then what is remaining in my fund, we have an 80-20 split. Some funds have 90-10, some have 30-30, 70-30, some have whatever. Then after that piece off the top is paid, then whatever is remaining of a net profit, then that would get split in that manner. So this would be defined in your PPM, exactly how that works, when it works, the timing. Also the method of subscription. How do you sign up for this thing? How do you get your money in? Where do the funds come to? What is our process to follow to make sure that it's received and it's received? A lot of us, like us, we use portals. You don't have to, but I just find it's a little bit more of a secure way to have the investor look at the documents from their computer and make their contribution via on the back end wire through their bank. That doesn't happen in the portal. It happens again externally, but it does register in the portal that you have made that investment. So your actual bank account details, well, it does. We do store your ACH information. So if we want to make a payment to you, we do store that in the portal, but we don't store your wiring instructions that, like incoming. That would happen to the bank on the back end, and we just register the investment's been received. You confirm it's been sent, and we confirm it's been received. So anyway, your method of subscription would be in there, your additional information. Also, you're going to have some exhibits. So exhibits are attachments essentially to this document. So we also have a more in-depth business plan summary that we always attach. So for us, that could be exhibit A, Z, whatever, it doesn't matter the order, but you'll have a business plan summary. So again, that will say, okay, well, what if we do this and it's not working? Then we have this plan, this plan, this plan. Exactly. And then also your exhibit will also be attached as your subscription instructions, your subscription agreement. You'll also have another, I already mentioned this earlier, attachment called an investor questionnaire. So this is seeing if you qualify for this investment. And then we keep that document on file because there are certain type of investors that qualify for certain types of investment. And if there's ever a challenge later on with the investor maybe feeling like they weren't ready for this type of investment or something, but they had actually self-certified that they understood the risks of this type of investment, then that document could be provided later for regulatory authority. And then also an individual questionnaire to understand, what your goals are, and then also as an individual or an entity, what type of entity. There's a whole list of the types that you're investing with. And then the final agreement or what we attach is a company agreement so that you have all of that for your records as well. So I won't read all of that, but if I scroll through this particular PPM, it is 66 pages long.
I know it's a long one. And thank you so much for walking us through. Yeah. And unfortunately, we are out of time. So I'm going to stop you right here, but I will have you back for another episode to cover more. It's like, you're just like a powerhouse of knowledge. So at this point, I'm going to ask you if you can share one golden nugget with my audience.
In regards to PPMs, operating agreements, etc., one thing I'll tell you that I would not feel comfortable, and I have been destroyed personally by not knowing that I could ask for this and then I could have this and it's normal, is that when you're looking at a PPM and an operating agreement, or if you're doing a different type of offering, if it's a term sheet and an operating agreement, they need to talk to each other. Like those terms need to match up. So one thing is inconsistencies, but the bigger thing for me is in the term sheet / basically the operating agreement. I mean, the team's agreement with each other. If you're sitting there stuck and you're a limited partner and you don't get to vote and you don't get to decide what happens to your money, if there's a disagreement, I would absolutely request and require from my team that there is a thing called an ADR, or an alternative dispute resolution, baked into that operating agreement. So what that is that talks everybody through, okay, we don't agree on something, everybody's butting heads, we're split down the middle with votes. And so, what are we going to do? Okay, so this is basically the document that defines, are we going to mediate? How many times? Who's paying for it? Are we then going to arbitrate? Is it or is it binding arbitration? So essentially, it's going to force the team to get to a solution without spending all of the money on legal fees, because typically they're actually indemnified by the company, meaning that they could just be mad at each other and spend all the company's funds, and that's ridiculous. So you want a specific agreement as to how to walk through a disagreement and get to the end of it in a reasonable time frame. So it's an alternate dispute resolution. Then the other thing that I really like is this thing called a buy-sell agreement. So for example, it's always in prenuptial agreements if you're getting married, and it's very similar. So just assume everything goes wrong. Okay, so what happens with our buy-sell? So if you want to leave, you're disagreeing, you want to sell, you want to, how does it work when this voting is happening and this person's disagreeing, or these people? How do we figure out the valuation of our shares? How do we agree to sell? Who gets first priority? And then essentially when we get down to that point and then there's still a disagreement, then we revert back to the alternate dispute resolution so that it will actually finish the process of, if someone decided to sell shares, making it whole and complete. So those are the two things that I would definitely want to see and I would require of my sponsorship team.
Thank you so much. So this brings us to our rapid fire round. I'm going to ask you 5 questions. I'm going to answer in 1 word or 1 sentence. Are you ready?
Yes.
What is one of the most important things that you have learned in your life, and how did it change your life after learning it?
I learned how to be present with other people and how to stop telling stories in my head of what I think they were going to say or who I think they are. That's one of the biggest things that I've learned. It changed my life in a way where even it doesn't matter what job I'm doing or what, level of person I'm interfacing with. When someone feels important and valued and I see them, regardless of how much struggle they're going through, they're still a valuable person, that absolutely changes the other person. And that rule of reciprocity, that is a gift that you can give somebody that no one ever does. And so you can't imagine how someone wants to just help you when you just let them know that they're important and they're heard.
That's so true. And better decision-making too, because you're not just engrossed in your own thinking and your own stories, whatever you're telling yourself. I love that.
Consideration is incredible if you can do that. Yeah,
exactly. What is one best book that you have read and you recommend to my audience?
Honestly, I'm reading it now and it's really technical. It just depends on what you want. If you want to be an active real estate investor, it's in my car. It's by IREM, Asset Management and Financial Analysis, something like that. It's by IREM. It's a really good asset management book. And it goes through the time value of money, all the way through like investment strategies, how you even come up with like the basis of your rent. It is not based on a market survey. Like, how does real estate and real estate finance actually work? That is an incredible book.
Great. In one word, what does life mean to you?
Right now, possibilities.
I mean, that's so true. It's true all the time. It's a universal truth, I would say. It's how you look at life. What is your biggest passion?
One of the things I get the biggest joy from, which I guess is a passion, would be when there are others that are struggling with things that are causing them to be fearful and scared and backed into a corner and abused and just turned into like, oh, you're nothing anymore. And being able to talk to them and give them resources and places to go and ideas and resources essentially to say, you're not alone. And I've been through that, or I know someone who's been through that. Here's the next 5 steps, just take it one step at a time, and having them just totally change the trajectory of their life and the level of stress. And when we tend to get into stress or distress, we tend to disconnect from everybody, or at least I do. And then you're not serving a purpose in the world anymore. So having someone kind of come out of that and then come back to having a good life and knowing where to go and feeling safe again, it's just really rewarding for me.
Making a difference. Awesome. I love it. If you could turn back in time and talk to your younger self, what would you tell yourself?
I don't know, because things have changed so much. Because I don't know if I would listen. If I went back and I said, what you're missing for the rest of your life right now is someone that needs to criticize you and poke holes in your ideas and essentially be like your integrator, that will change your life. Whether it's personal, whether it's business, whether it's what they can see your gaps, and they help you to say, okay, we're not going to go down that road. We're going to avoid that one. And here's some better options. So for me, someone that sees my gaps, finding that person and then being able to take to heart the criticism and learn from it and change from it, not to get frustrated or depressed by it. Yeah, that would be, I don't know if I would listen, but that would be what I could have taken off at like 19. Like,
that's good. So how can people reach out to you?
Sure. Go to my website, please, theapartmentqueen.com. There's a couple ways that you can either find investment resources for you, looking at past deals. You can involve yourself in any of our groups that are now doing coaching and courses as well when it comes to being an outstanding operator. Or on the website, if you go to the bottom, there's also contact information to book a 15-minute call if you're looking to actually invest.
Thank you, Kaylee. Oh my God, that was a super awesome episode. I love you being here today.